Hello, everybody. Welcome to our October webinar, Year-End Planning. I'm Betsy Kenyon. I'm the Marketing Director here at Elevate Wealth Advisory. And even though we have 2.5 months left until the end of the year, we know how things pick up toward the holidays. So we wanted to give everybody plenty of time to make sure they have the ducks in the row to complete all of the things on the year-end planning checklist. We have with us Brian Rosso. Once again, Brian is our Director of Operations and one of our wealth advisors. Brian joined our team last year as a wealth advisor and quickly was promoted to our Director of Operations. Prior to joining Elevate, Brian was 9 years as a portfolio manager with another local firm. And one thing you might not know about Brian is he is a competitive fisherman, and he spent the weekend at a tournament, and he does that regularly with his brother Brandon. And when he's not doing that, he's spending time with his wife and 2 boys here in Athens. Hi, Brian. So glad to have you with us again.
Hey, Betsy.
Well, I will let you take it away. What do we need to know before the end of the year?
Well, let's get that started then. Yeah, there's several things to go over. Let me share my screen. Should be seeing that now. So yeah, thanks for everyone for joining the call today. The purpose here is year-end planning, and that can mean a lot of things. To us, year-end planning are those actionable steps that we can take before the end of the year, sometimes a little bit after year-end, and it's the goal here is to put ourselves in a position to better ourselves next year and beyond. Again, this a lot of times is in the context of our finances, whether it be investments, taxes, income, and/or expenses. But year-end planning can also be and include planning for health and some well-being as well. So, what's the importance of year-end planning? There's a lot to go over here, but just to kind of highlight a few of those. The first one is identify opportunities to potentially minimize taxes over your lifetime. Improve current and financial outcomes, and possibly plan for life changes, whether you may have an income change or a job change, family changes, whether you're having kids or possibly getting married. And then also, not necessarily things that you plan for, but you could have some health changes in the current year as well. So for today's agenda, what we're going to cover are some planning deadlines. So that's going to take a portion of today. Also some gifting and Roth conversion strategies. And then while doing that, we also need to consider some potential tax traps that may be involved when we're recognizing additional income. So we'll cover some of those, and then we'll wrap it up with kind of the 2024 checklist that you can all have access to. So planning items prior to year end. Some of those is going to include open enrollment for Medicare. So the open enrollment window right now is October 15th through December 7th. And this is the opportunity where you can go in, make changes to your health and drug coverage. And this is an especially important year because there has been some significant changes to the drug plans for 2025. What they've done is they've capped the out-of-pocket expenses for $2,000 for the drug coverage, but the premiums haven't really changed a whole lot. So this year, it'll be more important than ever to go in, put your medications into the marketplace, and make sure that if you want to continue on your drug plan, that those are still covered under the current plan. November 1st through January 15th, if you're not Medicare eligible, you could also be on Affordable Care Act plan. So that open enrollment period is from November 1st to January 15th. Although it's important to know that if you do want your coverage to start on your ACA plan on January 1st, the deadline for that is December 15th. And then lastly, not necessarily a year-end planning item, but just something to always take note of, review and see if you have any updates regarding your estate plan. Really, we tell all people and most people that there's 3 really important documents that you should consider here. The first one being a last will and testament, and this is going to outline how a person's assets should be distributed after death. A power of attorney. This is going to give someone the authority to make those legal, financial, and or medical decisions on your behalf. And then also an advanced healthcare directive, also known as a living will. And this is going to outline those wishes for your medical care if you're unable to communicate those. So again, 3 important documents there. Year end is a good time where things start to slow down with the holidays to review those and make sure that they're up to date. So some, but not all deadlines for December 31. The biggie here is required minimum distributions. So who is required to take distributions? For those that are born between 1951 and 1955, your RMD age is going to be 73 years old. RMD age is going to be 75 if you're born after 1960. An RMD is a distribution that you have to take from a certain retirement account, and there's several types that fall under that category. Those are going to be traditional IRAs, employer-sponsored plans such as a 401k or 403b, also tax-deferred annuities, SEP IRAs, and simple IRAs. These are all subject to required minimum distributions based on your age category. I will note the one exception here is going to be for those employer-sponsored plans. If you're still working when you're in RMD age at that employer-sponsored plan, a lot of times you don't have to, or those type of accounts like the 401k and 403b are not going to be subject to RMDs as long as you're still working at that company. Another one to note is inherited IRA RMDs, and this is going to be in reference to mostly non-spousal. Typically, if you're a spouse and you inherit your spouse's IRA or Roth IRA, you typically take that as your own, and you would be subject to the normal required minimum distribution rules. So non-spousal inherited IRA are going to be a little bit different here. If you inherited the IRA before 2020, the beneficiary can take what's called a stretch, and they're able to calculate the RMD based on the beneficiary's lifetime. However, this has changed recently, and now if you inherited an IRA after 2020, you're typically going to be subject to what's called the 10-year rule, and you're could potentially be required to take annual RMDs. Again, this is going to be based on the beneficiary's life expectancy, but the big major change here is if you inherit after 2020, the full account has to be drained within that 10-year window. So there's a lot of tax implications and strategies that can be involved in when to take the full amount out. So a lot of people think maybe we should leave it in until the 10th year and drain it, but you'd also pay all those taxes in that year. So you really have to be mindful in which year you're taking those distributions. Again, there's a lot of rules around non-spousal inherited IRAs now, so we think it's also smart to consult a tax and or financial advisor. There's a lot of exceptions and a lot of rules that go into this. So if this applies to you, we think that's a good idea as well. Some other items to consider before December 31st. Employee contributions to those employer-sponsored plans. That does have a deadline of December 31st. So if you're contributing, you want to get those contributions in to maximize those in your 401k, 403b. Charitable donations and gifting. This is a biggie, and we'll touch on this topic a little bit more in a few. Roth conversions, looking at that and see if you have any room to convert traditional IRA assets to Roth. And then also tax loss harvesting. So tax loss harvesting is really a tax strategy where you realize losses in a given year to help offset capital gains, or possibly just to reduce your taxable income up to $3,000. Any additional losses that you may incur in a given year can help offset that $3,000. Any amount over that is carried forward to subsequent years. So it's not like if you don't use it this year, you lose it. You're able to carry that loss over, and you can offset other gains or income in other years. So tax loss harvesting involves selling an investment at a loss and purchasing a similar but not identical replacement. And this is an important distinction because um, this isn't an investment philosophy. This is a pure tax planning because you're selling one asset and buying something that's similar, so you don't lose out on market performance. But it's also important that you do not buy the identical replacement. So, for example, if you sell Coke at a loss, you don't repurchase Coke. Even it extends across all different account types as well. If you do this, this is what's called subject to the wash sale rule. So you cannot buy the same security within a 30 days of generating a loss. And if you do, the loss will be disallowed. So that's why it's important to make sure that we're buying similar but not identical investments. So another one to kind of consider here is if you are looking at selling an asset that may have generating some potential gains, uh, possibly spreading this out over multiple years. This can really help in kind of managing the taxes in one year versus another. And you also kind of help manage and spread those tax liabilities over multiple years. So a few April 15th deadlines. The first one here, we have HSA contributions. Um, in order to qualify for an HSA, you must have a high deductible healthcare plan. And under this, the eligibility, there are a few rules you'll need to know. So there's an annual deductible that has to be at least $1,600 for individual coverage and $3,200 for family coverage in order to qualify. You also have to have an out-of-pocket maximum, including the annual deductible, to not exceed $8,000, $8,050 for self-only coverage and $16,100 for family coverage. And then you also cannot be enrolled in Medicare and be able to be eligible for HSA contributions. A lot of times when we have clients that are looking at, should I go on Medicare or should I stay on my employer plan? A lot of that, sometimes that decision comes down to, do you still want to be able to contribute to an HSA? If they like their coverage through their employer plan and they're able to continue that coverage, maybe they continue that just so that they can continue contributing to the HSA. So that's one decision point. If you are still working and can continue on that plan, should you go on it or not. There are some HSA contribution limits for 2024. For a single household, that's $4,150. For a family, that's $8,300. And then if you're over age 55, you can add a $1,000 catch-up contribution to either one of those limits. Some additional April 15th deadlines here: traditional and Roth IRA contributions. So the max contribution for this year is going to be $7,000. And you also get a $1,000 catch-up contribution if you're over the age of 50. And this can be all in a traditional IRA, all in a Roth, or a combination of the two, but you cannot exceed the max contribution more than 7,000 or 8,000, depending on your age. Also, 529 contributions for education savings. This is going to vary a little bit state to state. We're in the state of Georgia, which is the Path to College 529 plan. And in the state of Georgia, taxpayers can also deduct up to $4,000 if you're in a single household, or $8,000 per beneficiary in a married filing jointly household per year. And this isn't you only get the tax deduction for the state taxes. But if that's something that you are actively contributing to, or maybe you have a Utah plan or some other plan, but you live in the state of Georgia, setting up a 529 plan through the Path to College will allow you to get a state deduction for your contributions there. So gifting, there are two main types of gifting when we think about year-end planning: non-charitable gifting and charitable gifting. And for non-charitable gifting, these are going to be gifts made to individuals that are not IRS recognized as 501c3 organizations. It can include your family, friends, other individuals. On the other side of that, charitable gifting these are going to be charities registered as a 501c3 according to the IRS, and it could be a church, a nonprofit organization, certain universities, school district programs. There's several different categories here, but that's just to name a few of those. So for non-charitable gifts, we often get a question, will I have to pay or do I get a deduction on those non-charitable gifts? And the answer to the first question is no, there are typically not tax deductions for charitable gifts, non-charitable gifts. And that's also unlikely that you will have to pay as the giver or receiver either. And so let's explain how this works. In 2024, there's an annual gift tax exclusion of $18,000 per person or $36,000 per couple. So if your gift is at or under this amount to a person, those gifts do not have to be reported at all. However, if those gifts are over $18,000 per person, these are also typically not taxable, but these gifts do need to be reported via a gift tax return, and this is the IRS Form 709. And a lot of people ask, well, if it's not taxable, then why do I need to report this? And the answer is because any amount over that $18,000 is going to be subtracted from your larger lifetime limit. Right now, the lifetime limit per person is extremely high. It's at 13.61 million per person, 27.22 million per couple. So typically, in most cases, even if you decide to give, say, $100,000 in a year, it wouldn't really impact that or get near what that lifetime gift limit is in 2024. But nonetheless, it's an accounting system. The IRS at least wants to know about it, even though it's not tax deductible or there's no taxes to be paid on that non-charitable gift. The second category here is charitable giving. And there's several classifications under this. The first one being those cash or check gifts. These may be tax deductible if you are itemizing. And the standard deduction for 2024 for married filing jointly, $29,200, single and have household there as well. So if you are gifting and you are itemizing, those are likely going to be tax deductible. The deduction limit here for those cash and check gifts are going to be 60% of your adjusted gross income. So there is a maximum amount you can gift and deduct, and it's 60% of what your adjusted gross income is. You can also give what's considered appreciated securities, and the deduction limit here is a little bit less. You can deduct up to 30% of what your adjusted gross income is in that year. The advantage of gifting something like appreciated securities is you avoid paying capital gains tax because you get to transfer it directly to the charity. So there's not a taxable event there. And then you can also deduct that full market value. So not just what you paid for that appreciated security, but the full market value. So kind of a double benefit there. So there are some charitable gifting strategies that we like to think about and look at as we head into year end. The first one of those is what we call bunching. This combines multiple years of gifts in a single tax year, and this is really to exceed that standard deduction so that you can itemize and get the most tax benefit from those gifts. One way we do that is in conjunction with what we call a donor advised fund. And this is a fund in which you contribute the bunch gifts in a single tax year directly to the donor advised fund. And you're able to gift out of that fund via grants to those charities that you want to support throughout the next 1, 3, 5, 10 years. So it gives you a lot of flexibility. Again, this is the purpose of this is to get the tax deduction in 1 year, and then you can spread out your gifts or grants over the subsequent years as you see fit. So a lot of people don't know, should I be looking at this strategy? And from an advisor standpoint, we look at there's three big deductions right now that may determine if this could be a good strategy for you. Uh, we look at three main deductions, that being your mortgage interest, your state and local taxes, including property taxes and income taxes. That right now is capped at $10,000, and then your charitable giving. Those are kind of the three things we look at to determine if something like a bunching strategy may make sense for you. There's also some other major deductions like medical expenses. If it's over 7.5% of your adjusted gross income, you can deduct those expenses as well. And then, more recently with some of the hurricanes going on, losses from disaster or even theft can be major expenses that are deducted. The second one here for charitable gifting strategy is what's called a qualified charitable distribution, a QCD. And to be eligible to contribute to charities via QCD, you must be 70 and a half years old. And a QCD is going to be paid directly to a charity from your IRA. The annual limit to do this is going to be $105,000 per year. So that's the maximum amount that you can QCD to various charities. Let's look at possible QCD tax savings. So here we have option one. This is going to be a non-QCD gift. So the charity is going to get the $10,000. $10,000 is going to be reported as income because this is a non-QCD gift. So our tax bill, based on a 24% tax rate, is going to equal somewhere in the ballpark of $2,400 on that $10,000 gift. So the total cost to you of that charitable gift may be $12,400 in total. On the other side, if we are QCD eligible, we give that same $10,000 to the charity directly from the IRA. So that $10,000 is going to be excluded as income. And the tax bill on that IRA distribution is going to be $0. So the total cost of that charitable gift is, instead of $12,400, is now $10,000. So that would be about a $2,400 savings using the QCD option. So again, this is just one easy way to change around the way that we contribute, even though the charity still gets the same benefit. This can help save us some taxes in given years. The second here is what's called a Roth conversion. We touched on that a little bit earlier. This is one of those deadlines that has to be done before year end. And a Roth conversion is when we move money from a traditional IRA or 401k into a Roth IRA. And doing so, that is a taxable event. You are going to pay income tax on that amount you convert. But after that, those earnings and future withdrawals should be tax-free if you meet specific requirements. And again, some reasons for doing a Roth conversion are going to be tax-free growth. It's going to reduce your required minimum distributions in future years, because moving those assets from the traditional IRA to the Roth, you're going to lower that balance. And that's going to also reduce what your required minimum distributions would be once you reach RMD age. And then it could also be a good opportunity for possibly lower lifetime taxes. Depending on what income bracket you are in, if you're in a low income year, you can take advantage of that and convert more dollars in those years. So you have some control over when and how much you do convert. And then lastly, we have estate planning. Roth IRAs are going to be passed to heirs tax-free. So if leaving a legacy is important to you, and maybe your kids are in a higher tax bracket, converting those dollars at lower tax rate and passing those on to the heirs where they'll be tax-free can also be another good reason to do Roth conversions. So there are a few strategies for Roth conversions. We've mentioned a few. One is called filling up the bracket. And here we have a little bucket and a pail. And before the conversion, we're sitting somewhere in the 22% bracket. Maybe we're still working, maybe we're retired, but taking income from other sources. And we're in this 22% bracket, but you can see there's some room we can fill up. So it's looking at where your income sources are, how much can we convert to really maximize that 22% bucket. And then you would do a Roth conversion and convert that from your traditional IRA to a Roth. And that is filling up the bracket. Again, you can take advantage of those low income years. So if there's a year where you're in a 12% bracket, maybe you want to max that bucket out and also the 22% bracket, especially if you expect your income to increase in following years. And then lastly, market downturns are also good times when you can do Roth conversions. You'll be able to convert a larger percentage of your IRA, and then as the market recovers, those earnings will be tax-free. So if we are looking at doing something like a Roth conversion, doing that is taxable. We're recognizing additional income intentionally, but there are some tax traps that we have to be aware of when doing so. The first one is called the Medicare Income Related Monthly Adjustment Amount, and that's IRMA for short. And this is going to be based on what your modified adjusted gross income is. And this isn't just in the year where you take the income. Those Medicare premiums are going to be adjusted based on what your modified AGI was two years prior. So for 2024, this is going to be for your income in 2022. So if you're a single taxpayer and your income is under 103,000, married filing and jointly under 206, you'll pay the standard $174.70 for Medicare Part B, and then you'll pay whatever your drug plan is for Part D. As you can see here, if we go over these tiers, there's adjustments. So the first one here is $69 a month plus for Part B, and then an additional $12.90 for Part D. And that can be a total of around close to $1,000 per person. So if this is a couple, this would double. And the thing with these Medicare IRMA brackets is if you go $1 over into the next bracket, you pay the full amount. So you really have to be mindful, especially if you're doing things like Roth conversions. You know exactly where your income sources are and how much you're going to get. So that's a lot of times why we like to wait to do Roth conversions at the end of the year, because then we have a better idea and a better picture of where your income will lie to execute these so that we don't fall in one of these tax traps. Another possible tax trap when recognizing additional income is something called the net investment income tax. And this is also based on that modified adjusted gross income. And if you are over these thresholds, these income thresholds, these MAGI thresholds, you will pay a 3.8% tax on the lesser amount of the net investment income or your excess over the MAGI threshold. So people often wonder what is classified as net investment income. And this can include capital gains, both long and short, dividends, taxable interest, rental and royalty income, and then also some of those past income investments that you're not actively working in. So how much could you owe under this net investment income tax? So we have a few examples here. Let's say you have $30,000 here in example 1 in net investment income, and your modified adjusted gross income is over the threshold by $50,000. You'll have to multiply that 3.8% by the lesser amount, which in this case is the net investment income. So 3.8% times 30,000, you would expect to owe an additional $1,140 in taxes based on example 1. Example 2 is the opposite scenario. So we still have that $30,000 of net investment income, but your modified adjusted gross income is only over the threshold by $15,000. So because we use the lesser amount, 3.8% of $15,000 is $570 of additional tax that we could expect to pay under this potential tax trap. So again, it's really important to know where your income sources are, what types of income you're generating. That way you can efficiently manage around those if possible. And then lastly, we have the financial planning checklist. There's several of these out there. We really like this one because it goes over a plethora of different topics. It goes into taxes, investments, certain age milestones, some retirement uh, questions, insurance, health, family, and life changes. So there's a lot that goes into this. And we think it's a really good tool, especially if you plan on having a meeting with your advisor as year end approaches. You can go through this list, see if any of those apply to you, and you know, ask us how could this help you with your year end planning. So yeah, we have this on our website. I think we'll also have it in the description when we post this to YouTube. So you're feel free to get a copy of it and let us know if you have any questions on that. And thank you. And I appreciate the time for everyone taking, and uh, maybe we have some questions.
Thank you so much, Brian. Great job as always. We do have one question that's come in. If anyone else has a question, please drop it in the chat box or the Q&A box. The question is, are these year-end planning strategies something we can do every year, or will we have to look at each year differently?
Yeah, that's a really good question. And I think the answer is, maybe the strategies don't change, but to your situation, that will likely change. A lot of these are going to be based on tax rates. And so those tax rates will possibly change. Right now, the Tax Cuts and Jobs Act is going to expire in 2025. So if that does sunset, the standard deduction is going to be cut in half, and there's going to be more deductions you can take. So some of these strategies that may work this year or next year may not work going forward. So I think this is definitely, you have to take each year in isolation to make sure that you're really maximizing all of these strategies in a given year based on your income, tax rates, and potential changes.
Very good. We typically start talking about this with our webinars in October, but when is the best time of year for people to really get started looking at these year-end deadlines?
Yeah, I mean, I think that's why, year-end planning never stops, because you can start 6 months ahead and also 6 months after, especially if you're looking at doing Roth conversions and something like that. There are ways that you can structure your income potentially so that you can convert more if that's a strategy that appeals to you. So there's certain things that you definitely want to look at forward looking, because that always is going to help you figure out which one of these strategies is going to be most relevant for you, and you can take advantage of when it does become, at the end of the year.
Thank you so much. And as Brian mentioned, I will go ahead and send out the year-end planning checklist to everybody. We do have it currently on our website in our lifelong learning library. So if you go to elevate-wealth.com and click resources, you will see the lifelong learning library. All you have to do is create an account. There's nothing, no secret information that goes in there, really just your name and email address. You set up the account, and you can access all of our PDFs, such as this one, and then our key financial data card, all the things that we typically reference. So feel free to do that, but I will be sending this out, and you are welcome to share it with your friends and family. I'll also share a link to the recording once it's up on YouTube, and you can share that with your friends and family as well. Thank you so much, Brian. We really appreciate your time.
Thanks,
And
Betsy.
yeah, next month we'll be talking about another year-end topic, which is year-end gifting strategies. And I know Brian talked a little bit about those today, but we'll go into those in further detail. So all you have to do is go to our website and look on our webinars, and you can register for that as well. So until then, we hope you have a great rest of your month. And thanks again, Brian, for everything.
Bye. Thank you.
Bye. Take care, everybody.